Welcome back to the channel. My name is Joseph Gutierrez, and this is covering compounding. In today's video, we're going to talk about how to fit long-term care insurance inside of a well-designed retirement income plan. We're going to be talking about how to use asset-backed long-term care, specifically with our preferred carrier, Guardian Life, and their whole life policy. A lot of agents out there think that it's one or the other, and we're going to show how you can have both, how you can have high cash value that's increasing and we can utilize for any general liquidity needs in retirement, and we can have a high long-term care benefit pool to draw from tax-free for any of our long-term care needs. Very important when it comes to retirement income planning and a necessity in my opinion. So let's go ahead and take a look. All right, let's go ahead and hone in on the long-term care option we're going to be looking at with Guardian Life. This is an asset-backed long-term care policy and how it fits in with our model for retirement income planning. Remember, we have the retirement ready model that we like to talk about here on the channel. The middle layer is health security and legacy. How does this fit in with our overall retirement income plan for the security benefit of knowing that no matter what happens with our health, we have the funds there for that. We have the income to protect ourselves and our family. Okay, very important. But before we get into that, it's good to touch on why we need this in the first place. Because a lot of times people will just kind of throw it off and say, well, maybe I don't even need long-term care. Maybe there's another way to do this. Okay, maybe I can just self-insure, something like that, right? Now, one thing that's pretty striking, and we'll just kind of quickly write this here. So we're talking about long-term care. One of the statistics that's pretty striking for many incoming and current retirees is that according to the Department of HHS, so Department of HHS, it says that 70% of 65 plus year olds will need long-term care, LTC, services in retirement. Okay? 70%. 70% of us, when we make it past age 65, we will likely qualify for long-term care or need those services to some extent. Okay? Now, we've talked about this in previous videos. We made a little metaphor that if we had a six-sided die and we threw it down on the game board of life, if we got a 1, 2, 3, or 4, that roughly coincides with the 70% chance of needing long-term care services. And remember, long-term care is not cheap, not in the least, okay? We're looking at usually on the order of, so LTC on a monthly basis, we're looking on the order of $6,000 to $12,000, okay? And these tend to range between, might be on the lower end, maybe 6 months, but a lot of times it's 2 to 4 years, and sometimes for kind of more mental degenerative diseases, could be even 10 years plus, okay? So remember, this is very significant. A lot of families go through this where not having the funds in place, not having any kind of insurance in place, puts a huge drag on the family finances and the retiree finances to get through the long-term care scenario. Now, we're looking at this statistic here of 70% of any particular 65 plus year old. A little bit of a pop quiz for you if you remember from your old probability statistics classes. If we have a 70% chance for a 65 plus year old, what is the percent chance that a married couple will need long-term care? Whether the husband needs it, the wife needs it, or they both need it. What are the percent chance? Okay, so I'll spare you the details too much, but we'll just kind of put it here on the screen for you. If we take a look, okay, the probability of needing long-term care is 70% or 0.7. We're using the variable p equals 0.7. Well, if 70% is well the chance that we need long-term care, what's the chance that we don't need it? Well, obviously it's 30% or 1 minus p, so it's 0.3, okay? Now, the next question is, well, if we have two people, assuming some level of statistical independence, what are the chances that neither of them need it? Okay, so the probability that not the husband needs it and not the wife needs it either in this hypothetical example. Well, it would be a simple formula of 1 minus p squared, which coincides with a 0.09 or 9% chance. So just think about that for a moment. There's a 9% chance the average married couple, statistically speaking, will not need any form of long-term care services. Okay. And then by extension, if we're going to say, okay, for both scenarios, for either or scenario, whether the husband needs it, the wife needs it, or they both need it, it's a simple formula here, 1 minus the difference of 1 minus p squared, which comes out to 0.91 or 91%. Okay, this is particularly significant. So statistically speaking, 91% of married couples 65 plus will have some kind of long-term care qualifying event, will need specialized services. It's one of those things that it's that a number of clients kind of feel on the inside, and we don't have to go to, statistic modeling or talk to an actuary to feel this out. The average retiree kind of feels it on the inside, knowing that, maybe I should hold on to my funds because I don't know, I may need these services, right? I may need a home health care provider. I may need services for any kind of variation on the scale of needs, whether it's home health care, whether it's some type of custodial care, adult daycare, or more, chronic, more permanent kind of needs, nursing home and kind of things like that. A lot of our clients kind of feel this out on the inside, and many of them have a hard time even talking about it because they don't want to talk about it. It's understandable. It's not something that anybody really wants to talk about, but it's a real, very real scenario. And the trying to just kind of phase it out of your mind can be quite detrimental to your finances in retirement. Okay. And one of the things that we want to kind of bring up as well is that for those that maybe are on the fence about long-term care, I want you to reconsider, because if we decide to self-insure, okay, put this here, we're going to self-insure, right? We'll hear this from clients sometimes, from prospective clients. Well, I'll just self-insure. I'm not going to really worry about it. If it happens, it happens, and we'll just take care of it. Well, self-insure is kind of a misnomer. You mean self-fund, because insurance denotes that there's a body of policyholders, an insurance company that backs the promises of whatever contract. So we're talking about self-funding, right? The issue for a lot of retirees is that most of those funds are coming from qualified accounts. Okay, IRAs, old 401ks, money that you've saved up. Okay, the issue is that that has not been taxed yet. Okay, so if you have a qualifying event and you need long-term care and you need, let's say, on the order of $10,000 a month, okay, for this long-term care event, and we could say maybe it lasts you 30 months, okay, that $10,000 actually translates to about 14,285, I believe, if we assume like a 30% tax rate. Okay, just round numbers here. That's 14,000 plus dollars that you actually have to draw from, to part of which pay the tax man, and the other 10,000 to pay for the medical costs of those long-term care claims. Just factor it out. Just, if we have 3 years of long-term care needs, well, we're looking at more than $420,000. So $420,000, for example, of LTC needs. Okay, this is significant. Okay, money that's was supposed to be used to give to the family, or maybe used for fun, or kind of enjoy retirement, now has to be siphoned off just to maintain some balance in life and in retirement. Okay, not having to rely on other family members, and not having to undergo any other hardships. They will have to draw a significant amount of money to handle his long-term care requirements there. And this kind of stuff happens all the time where basically families essentially start running out of money and having to rely on their children to get them through retirement. And unfortunately, I heard another story, and I hear these stories all the time, interface with home health care personnel from time to time. And I interfaced with one last week. She told me a story about a doctor from Ireland that his wife was from here. They moved back here. They didn't have any kind of long term care insurance. And as they got through retirement, the wife ended up needing long term care. And then the husband also needed long term care. And they were essentially drawing from their savings and self-funding. Well, what ended up happening, the long story short, they obviously needed it. They ended up both passing away years later, and they're in a situation now where their kids are still picking up the tab for those long-term care needs that they were drawing from throughout their retirement. Basically, which is kind of a soft way of the long-term care expense made them go bankrupt. And we hear stories like this all the time. Okay, so where the kids kind of have to step in and either physically be there or financially be there or both to kind of take care of their aging parents. Okay, and this is a lot, kind of a fear that a lot of retirees have, and one that we really should be planning for. And that's why in the retirement ready model, the long-term care insurance is an integral part. It's the middle of the triangle for a reason. The health security and legacy, having something in place, having that protection in place, it can literally save family fortunes. Okay, that money shouldn't be going to a home health care facility or to a nursing home. It should be going to your family. You should have a nice pocket of money for designated for long-term care, and the rest of your savings, your inheritance, should go to your family. And that's kind of what it's for, to protect the family, protect yourselves. Okay, so now that we made that point, let's talk about how long-term care insurance can be structured. So we're going to take a look here. We're talking about a whole life policy with LTC rider. So what does this mean? Well, we're going to design a whole life policy that's going to have a cash value and death benefit component. Okay, so what's great about these types of policies, unlike these standalone traditional long-term care policies, which are still great, we do those too, is that we have access to our funds, right? We have access to the money that we're putting away into the policy. We can access it for long-term care needs, and we can access it for the cash value. So the cash value is great because this is our tax deferred and growing general liquidity. Okay, very important. So the cash value is there. We're structuring so this is an asset to us in retirement. It also means that we have a long-term care rider, which tends to be more on the discounted variety as far as the cost goes to carry that rider. And that also has a growing and significant LTC pool. Okay, and that pool can be drawn from for any kind of LTC event. If we haven't mentioned thus far, those long-term care events can be triggered by not being able to perform two of the 6 major daily activities of living. So that means dressing, continence, eating, transporting, toileting, things like that, or obviously any kind of mental degenerative disease, think Alzheimer's, dementia, things like that, where you need supervision. That's also a qualifying event. And remember, one of the reasons we really like these types of policies that they're both tax-free. We have tax-free liquidity access in our cash value through policy loans. We talked about this in previous videos. You don't have to be a 40-year-old entrepreneur to go put together an IBC, infinite banking type policy, and borrow from your cash value for what you want to do in retirement. You can do it inside of a whole life policy with long-term care. And additionally, of course, with the long-term care rider, we have the access for those funds. Okay, so we have a benefit pool. Okay, so this is particularly important. So we have both. We have the cash value for accessibility, general liquidity. Okay, because we may have our other funds tied up in investments, tied up in guaranteed floor type annuities and annuities that are growing in the background. We want to be able to have some liquidity in case we need it for whatever we're trying to do, whether we're out going to go buy a new boat, whether we're fixing up the house and we need 10, 50, 100,000 plus dollars, it's going to be inside of our policy. Okay, and it's always growing for us so we can access it whenever we want. And if we do have a long-term care qualifying event, then we have this large liquidity pool in the long-term care rider. Now, before we get to the actual illustrations, and we're going to go over that as well with Guardian Life, I do want to touch on something that a lot of agents will turn to and kind of just depend on, but it and kind of use it as a substitute for long-term care, but it really isn't. And it's important that the word kind of gets out. And unfortunately, I've seen this more than once where a lot of agents will kind of say, oh, you don't need long-term care because we have a chronic illness rider. With our whole life. And we can depend on the chronic illness rider. It also has 2 of the 6 daily functions of living as a qualifying event, and it happens to be free. So it's a free rider. So what do you need the long-term care for? Just depend on the chronic illness rider and then just put all the money in a cash value and away you go. Well, the issue with that is that that's not really true, and it's very misleading. And I see this a lot. It's in my opinion shameful. But one of the things with the chronic illness rider that you need to understand, this is an accelerated death benefit. So accelerated DB. So what this does is it accelerates the death benefit early for that chronic illness. It's usually like a lump sum. It's not really a monthly payout structure. The main issue is that the qualification is harder. Okay, with traditional long-term care, it could be a permanent condition or it could be temporary. Okay, with LTC. It can be either of these. With long-term care or with the chronic illness rider, unfortunately, it has to be deemed permanent only. Okay, so if the doctor that's a qualified practitioner, long-term care and services for elderly clients doesn't deem it permanent, then you cannot access those funds. The other major issue that I've seen, and I haven't seen any other agent talk about this, and this is a big problem, is that when we access the accelerated death benefits for chronic illness or whatnot, it is treated as an interest bearing lien. Okay? It's treated as an interest-bearing lien. So what does that mean? Well, basically you have your death benefit portion of your cash value, and you have an interest, and you have the lien that's placed against for the amount of money that has been accelerated. So if you have a $500,000 death benefit policy and you accelerate, let's say $450,000 for a long-term care qualifying event, right? A chronic illness event. Well, the issue is that that's treated more like a policy loan. The policy loan charges interest, usually in the 5% range. The problem is that for a lot of people that are going through these long-term care events, they're kind of tough, and a lot of finances start getting kind of tight. And what ends up happening is that this interest starts accruing, and the policyholder may know about it, but a lot of times not take care of it. And what happens is that it can, in fact, extinguish the policy completely. So what happens is essentially the interest eats up the remaining cash value and death benefit to the point that the policy terminates. Okay, this is not an issue with the long-term care rider. There is a lien against it, but it's a non-interest bearing lien. It's just a certain percentage, a certain amount against the death benefit, but it doesn't actually accrue interest negatively. The chronic illness rider does accrue interest negatively, and it can lead to policy terminations. And unfortunately, what ends up happening is that we're going to have a tax bomb. That's kind of like the nomenclature people use. And the issue with this is that once the policy extinguishes, once the policy terminates, the IRS is going to view it as a taxable event, and then you're going to have a large tax bill. Think $50,000, $100,000 tax bill on top of the fact that you don't have your policy anymore. It extinguished because of interest that you may not have paid. And if you do end up paying it, well, lucky you, you get to be paying, I don't know, if you pulled out $400,000, you get to be paying somewhere on the order of $20,000 plus every year in order to maintain that policy and keep it from lapsing or terminating. So this is pretty rough stuff, and I don't recommend the chronic illness rider for a number of my clients. Now, if I'm working with somebody who's 45 years old and has had a policy for 20 years, he probably has a bunch of cash value, and the chronic illness rider probably be okay. I would usually recommend, in that case, a standalone policy just in case. So just have the standalone policy, and the chronic illness is kind of like a backstop or a backup plan, a plan B. But I would not depend on this, okay? Because it can turn into a situation where the policy ends up terminating on you, and then you're going to have a huge tax bill. I haven't heard any other agents talk about this. The ones that are talking about relying on the chronic illness rider, they're not talking about this tax bomb. This is significant, okay? And considering how relatively inexpensive long-term care is, it's just not worth it, okay? So in my opinion. So now that we got that out of the way, let's go ahead and take a look at some illustrations, some actual numbers from a policy, so you can get an idea of how this policy is constructed and how it can benefit you in retirement and cover your long-term care protection needs. All right, let's go ahead and take a look at a ledger, an example scenario for a 60-year-old male, and show how he can structure a whole life policy, an asset-backed long-term care policy, whole life through Guardian Life, okay? And how we design in such a way that he has a large amount of cash value that he can use throughout retirement at his discretion, and then also have that large long-term care benefit pool just in case the need comes up, okay? So let's go ahead and jump on over. So this is Guardian Life. The way we model this is a 10-pay. Oops, let's go here. The way we model this is a 10-pay design. So whole life plus LTC rider. Okay, and we can see here that on the leftmost column, okay, let's see if I can, the leftmost column here are base premium. Okay, so it's mostly base design. That's how you put these kind of policies together to maximize the long-term care, of course. Is that we have $24,404 towards the base part of the contract, which builds cash value, and it's a 10-pay product. So we're going to kind of accelerate that cash value growth. But notice that the net cumulative amount right here is we notice that there's basically a little less than $600 difference between these two numbers. Well, that coincides with the LTC costs. So the long-term care costs are only roughly $600 per year for those 10 years. Okay, so when people say, oh, long-term care is super expensive and all this, that, and the other things, like, well, if you design it in such a way with a whole life policy like we're doing here with Guardian Life, there are other carriers that do this as well. We're featuring Guardian Life for today. We can kind of minimize that cost, but also make the amount of premium that goes into this policy more accessible, more accessible. We can see that over this 10-year period, we put in $250,000 of funds into the policy, and we have $260,000 and growing year after year in cash value and death benefit. Okay, so in this way, we're kind of turning into like a 10-pay design that mimics some of the aspects that we have in infinite banking. So the IB's infinite banking concepts, the IBC. Okay, so we've talked about this in other videos. You don't have to be a 40-year-old entrepreneur, real estate investor with hundreds of thousands of dollars to throw into a policy. You can be just an average retiree that just wants to have a policy that takes care of their long-term care and also builds this cash value. Remember, this cash value here is accessible through policy loans that we can use for whatever we want to do. So let's say we're 70 years young here, and we're going to, I don't know, we need money for whatever we want to do, whether we got home improvements, maybe we want to buy a boat, maybe we're going to enjoy our retirement. Okay, and I need to borrow, I don't know, 50, 100K, 50 to 100K from the policy. Well, we can borrow those funds from our cash value, okay? And we don't necessarily have to sell our assets to cover the cost for whatever we're trying to do. It's easy, quick liquidity. Generally speaking, the insurance companies, basically sitting there ready to hand out the policy loan. It usually takes in about space of about a week before we put in the request for the policy loan and when it's funded. There's no credit checks, none of that. This is your asset. This is actually your money, so you have access to it. Okay, the policy loans are somewhere on the order of about 5%, depending on the carrier we're talking about. Guardian is about 5%, and then we can use that money at our discretion. And what's great about these types of policies, if let's say we're going to go, work on the house and buy some toys for ourselves in retirement so we can kind of enjoy things a little bit better, we don't necessarily have to pay those funds immediately. We can defer for as long as we want. This is not a HELOC. This is not a home equity loan that charges us 10% interest and we got to start making payments immediately. Very different with whole life. We can defer out and take care of those funds later and pay them back later. And what's great about this is that if we borrow from our policy, we can pay back our funds, but we're still growing on the full amount. We're still growing on, in this case, $273,000. Just $50,000 to $100,000 was pledges collateral with the insurance carrier for that loan that they gave you. Okay, so we're still growing on our money. We have our infinite bank and we're utilizing it. Okay, and we can utilize it when we're young and we can utilize it when we're in retirement just the same. Okay, so the way we design this is so that we can have that extra flexibility, those extra features. Having that liquidity is important. Remember, a lot of retirees, they're structuring their funds in annuities for their annuity floor, maybe some kind of accumulation, later income. Maybe they have stocks, maybe they have real estate. They don't want to sell right now. They don't want to liquidate their other assets right now. They don't have to. They can just go to their policy and pull out the funds and pay their policy loan back, pay themselves back, as they call it, whenever they want. Okay, so we'll go ahead and move over to the next illustration here. We're going to see the basic long-term care pool. You can see that right over here. Okay, you see about $322,000, which basically equates to about 95% of the death benefit. Okay, 95% of the death benefit is available in the basic long-term care pool. Now, the way we design this is that as the policy grows in cash value through dividends and all that other stuff, we're also growing the long-term care pool. So we have a guaranteed long-term care pool. Okay, so that's what this is over here. We also have additional long-term care pool, which equates to our total. Okay, so we can see that our total long-term care pool is increasing over time. Starts at around a little over $300,000. By our mid-80s, we're getting close to mid-5, almost $600,000. So $300,000 to $600,000. And we can also see here, which is pretty cool, which is a feature of these types of policies that you can enable. In this case, we enabled it, where we can have a growing monthly benefit. Okay, so we start in the $6,000 range, and we can see it growing over time. So not only is our long-term care pool growing, but also our maximum monthly benefit, all for those roughly $600 of premium towards the long-term care rider for those 10 years. Okay, so it's, in my opinion, it's a steal because it grants us access to all these other funds. It's easier for the insurance carrier to support this as opposed to standalone policies, which are fine, lower premium, but they have a use it or lose it type of structure. With this, it's backed by the whole life policy, so we can kind of lower our premium towards LTC and have more of it available and have higher monthly benefit numbers. Okay, so that by the time, let's assume that we may need long-term care, we can make a assumption here that somewhere around our 84th, 85th year, we can see right here that we have over $11,000 per month to draw from, a minimum number of 50 months. So you don't have to pull all that $11,000. It's optional, but that is your maximum limit for that month and up to roughly $600,000. Okay. Now remember, the other thing about Guardian Life, we're talking about Guardian Life, is that they have indemnity style distributions from LTC. So what does that mean? Well, remember, there's indemnity style and then there's reimbursement. So indemnity, what this means is that essentially the insurance company is just going to send you a check. They're going to send you a check. They're not going to ask as soon as you qualify. They're just going to send you a check for however much you want up to your limits here, depending on when you need the LTC coverage goes into effect. They're just going to send you a check. So what some people do is they help maybe they get a family member, they'll pay their family member to stay home and take care of them. They'll go get professional services, but essentially the insurance carrier doesn't need a bill. You don't need to be sending them bills so that we can have a reimbursement. Okay, that it's indemnity style, so they're just going to send you a check and you do with it what you want. It's actually a lot more freedom in that aspect. Not all carriers do that, by the way. So Guardian's pretty cool for that. We like Guardian for that. Guardian Life. Okay, and this is some of their illustrations that we're going over. Okay. So moving on, two more here. Okay, we can kind of see, it's talking on this particular illustration page, we can see the cash values, the benefit pools together, and then assuming these IRS limits. So basically the IRS for inflation concerns will raise the limits roughly about 3% per year. We kind of show how if the policy is pushing up against those hard limits or not. In this case, we're underneath those, so we don't really have to worry about that. But we can see that let's say our 84th year, we need long-term care insurance. We have $527,000 of cash value. We have $621,000 of death benefit. And then we have this non-guaranteed pool that has grown based on dividend rate that are likely to continue. Okay, they're non-guaranteed, but for the most part, Guardian Life, MassMutual, all these different carriers, they're pretty darn close to the illustrated numbers over the long term. We should have somewhere on the order about $587,000 in our total LTC pool, assuming we set up the policy this way. So basically we can draw from those funds and we have an ample amount of cash value as well that we can use. So we kind of show how they all interact together, and the whole life kind of backstops that long-term care benefit pool. Now let's jump over the last one here real quick, going over a long-term care scenario. So let's say we do need long-term care services, and in our 85th year, the previous year, 84th year, we had $587,000 plus sitting in our long-term care pool, and we need the $10,000 a month per month. And we're going to assume for 3 years. Okay, kind of right down the middle. The averages are usually between 2 to 4 years. It can go longer than that, can go shorter than that, but usually we see 2 to 4 years of a need for long-term care. So what does this mean? So we're pulling out, remember, this is tax-free, okay? ever since the HIPAA Act, basically codified, the IRS codified that these distributions, as long as they qualify, are tax-free, these long-term care distributions. So we're getting $120,000 tax-free. We don't have to worry about pulling money from our IRAs. $120,000 for 3 years in this case. So basically that turns into what? $360,000. And let's say for whatever reason we pass in our 88th year, or the client here passes in their 88th year. What do we have? We have another $318,000 in the following year there to give to our beneficiaries. Okay, so remember, we put this policy together years ago. We were in our 60s. So basically, we put $250,000. That was our basis, if you will. It turned into $360,000 for LTC. Oops, LTC. Then we have a $318,000 death benefit in this example, right? Obviously, if it's later or if it's earlier or later, it's going to be different numbers, but just for this example, right? This is just an example. And we had access, to hundreds of thousands of dollars in cash value. That's our liquidity. That's our tax-free and growing liquidity. We're able to do both. We had this large and growing LTC pool to cover us and protect our family so we don't have to liquidate all of our assets for a long-term care event. And we also had a large amount of funds, almost the same as the long-term care pool, that we could draw from. Okay, so this is basically our cash values growing, basically a bond yield like, so roughly about 4.5, roughly IRR, depending on when we put together and some of the specifics, 4 to 5%, something like that, of growing tax-free liquidity that we can grab, that we can borrow from. We're utilizing the principles from infinite banking concept, and we're using them in retirement, right? We didn't have to just have a bunch of LTC and no cash value. And we didn't just have to have a bunch of cash value and a chronic illness rider that actually doesn't really help us in the long run, could be very detrimental, and we didn't and not have any LTC. We could have both. And in this example, we wanted to showcase this to you on how you could structure both together so you can have the best of both worlds. You can have the protection, you can have the growth, you can have the easy access, all in one policy. Okay, this is part of our retirement ready triangle here we talk about all the time. The middle layer, the health, security, and legacy. And remember, we haven't mentioned it already, if we never need to use the long-term care at all, whether we use the cash value and pay ourselves back or never touch the cash value, we have these large amount of death benefits that can be used, that can be dispersed to our family. We'll go back here. We have this large death benefit that's going to go to our beneficiaries, to our family, tax-free. Okay, so it's not a use it or lose it scenario with these kind of asset-backed long-term care policies. And one of the reasons we like to incorporate them in retirement income planning for our clients. All right, thanks again for watching today's video. We talked about long-term care insurance and how to structure it in asset-backed long-term care policy. So the whole life policy with the long-term care rider. We saw how we can have our cake and eat it too. We can have a large amount of cash value to use for whatever we want to do. We can have a large and growing long-term care pool to draw from, all that being tax-free. And if we never need any of it, we have this large death benefit to pass on to our beneficiaries. And even if we only need to use some of the long-term care, we still have ample amount of cash of death benefit to give to our beneficiaries. And we had all that cash value to use for whatever we want to do. Whether we're going to use it for fun, gotta buy a car, remodel the house, whatever the reason is, we have this liquidity pool available to us so that we can access it if we need to for whatever reason in a quick minute and not have to sell off our assets or do anything crazy too quickly. We have some security, we have some liquidity, very important. Okay, Once again, thank you for watching. Be sure to get your free copy of our ebook here. Okay, this is the Retirement Ready Model. In today's video, we focus mostly on the health security and legacy portion of the triangle. So important. Not having this in place can mean the difference between bankrupting yourself in retirement or surviving through those kind of hard conditions if they do happen. And we saw, statistically speaking, it's going to happen to a lot of us in retirement. It's best to have a plan in place. Even if you want to do just a small standalone policy, that's great. Other clients of ours, hey, they want it all. They want the cash value, they want the legacy planning, and they want that nice, large, and increasing long-term care pool. Okay. Once again, thanks for watching. Be sure to click like and subscribe. Ring the bell for future notifications, and I look forward to helping you become retirement ready. Until next time.